Wednesday, June 14th, market analysis, Stan Ehrlich. We have more strength in the stock market indexes perpetuating the bull market of 2023. I always start out with the spider, the S&P 500 and the stock indexes, and then go to futures. Sometimes I'll include sectors, symbols, forex, and even crypto, and only if I think it's relevant for new signals. So we're going to look at the S&P 500 daily data chart. We bottomed out on October 13th with a gigantic ER bullish buy signal, slap you in the face with a buy signal. Fantastic. So that is holding. Bottom formation developed, major breakouts developed. We're on our way up, but during bull markets, you get overbought occasionally. For the last few days, we've been overbought, and that implies that we are about to have some sort of downside correction, typically very minor, doesn't last very long, doesn't go very far. So if that's true, and I believe it is exactly correct, a little tricky picking the day or when it exactly starts, but the amount of dip, we have a gap to close. So the first level at which it might turn back up again would be 434. That closes a gap from a couple of days ago. There's support that starts at 430 to about 26 and a quarter, 426 and a quarter. That area we would watch for buy signals. In a major longer term support area that's in a red hue in the background, and the recent trading range for a week. Also, there's a gap to close at 422.88, give or take a few ticks. 423, we'll call it 423. This, to me, looks like the most likely price level that the market might dip back down to, about 15 points from where it is. Nothing particularly dramatic or terrible. And as long as there is no huge sell signal, I would expect to see the market bottom out in that ballpark and maybe a little higher very soon, next few days, next week or so. Now, there's a chance it could dip down a little bit further without doing any damage to the long-term trend. So, as I have always done, I will try to pick the turning points for you and tell you how far it's going to go and maybe how long it's going to last. Yes, the DIA and the QQQ and the Russell 2000 are extremely similar to slightly different reasons sometimes. So the DIA, it has what looks like a very large, nice head and shoulder bottom with the first shoulder lows in December. Then the head of the formation, which is the lowest low for the formation, on March 15th. And the last shoulder low only a few weeks ago, May 25th. The neckline is drawn in the usual manner, and we have broken above the neckline. Just a moment, I'm discovering something here. I have to make a minor adjustment, and I apologize for that. There we go. The neckline has been broken yesterday slightly, but not by very much. And today we are 100% below the neckline, so I would not call yesterday a breakout. Plus, there's a possible exhaustion gap yesterday as it popped up. We all know there's an FOMC meeting or commentary this afternoon, late this morning, California time, in about an hour, and that could cause the market to pop up or break down one way or the other. Now, I'm obviously, and have been for quite a number of months, bullish for the bull market of 2023, I keep calling it. That's not the issue. The issue is where we're going to have these bumps and grinds along the way. And I think because of the overbought condition at a resistance area for different symbols, different reasons, we are about to see, or are starting to see, the DIA didn't even make it higher than yesterday's high. The Qs have done so, and the S&P have done so, and also the 2000 I'll show you in a moment. But the DIA has had a little trouble, and it's not higher than yesterday's high. It came down and closed that small gap. The S&P still has the gap to close. And there is a gap down on the DIA down at 332. That is a possibility. In fact, it's around a bull trend line. So that's not out of the question. Now, the downside potentials for the QQQ, which is overbought in the last couple of days, and a few days prior to that, including a bearish engulfing sell signal that did not work a few days ago. But remember, these sell signals and buy signals sometimes cluster. There are 2 or 3 or 4 of them within approximately a month. Most of the time, one of them is the highest high for the whole damn move or the lowest low for the buy signals, of course. So we'll see what happens. This is a prime territory for the market to get below yesterday's low and generate a red bearish engulfing sell signal. That would probably be because the FOMC meeting announcement, commentary, whatever, is not very well accepted. Also, another comment, people. It appears that the market is fully expecting good news on the average, bullish news on the average, economically, fundamentally, to drive the trend. But markets move on anticipation and reverse on realization. One of my favorite little sayings. So once the news is out and it's good, like expected, there's nowhere else to go. Everybody else looking for the good news is already bought and is making money. And there's no follow through to the upside on the news unless it's substantially better than the expectation. That's a little different, but not too much different. I'm still looking for a correction, period. It almost has to happen, almost. So keep your eyes open for the next buying opportunity. It'll be in several days. It might be a week or so. In the QQQs, we also have a gap to close down at 333 1/3. That's the lowest I'm looking for on the downside correction. There are no other gaps recently, but it is overbought in the last 3 days. And we had that bearish engulfing. So I'm very much looking for downside corrections on all of these stock market indexes. The 1 minute data for the QQQ is still relatively firm, steadily going up on the average, but breaking below these minor midday lows into a minor support area from the previous day's trading range, that could start something on the downside. We'll have to wait and see. The daily data chart again is overbought. That's the key. My signals are generated as a result of price activity on the daily data. The 1 minute charts execute and follow and exit the entry and exits and the actual trades themselves. That's why I look at the 1 minute charts often. Now the 2000 is very much in the same ballpark. Its rally is up into a major resistance area and stalled out yesterday, and a little bit higher for today's high than yesterday's high, is also stalling out and is currently lower on the day by 3/4 of a buck. So it could easily have a bearish engulfing red sell signal today if it drops a little bit more and below yesterday's low. I'd like that. That's exactly what I'm looking for. We'll see if it happens or not. Again, the FOMC meeting in about an hour is probably going to cause something good or bad, strong or weak, to happen. And if it's bearish, I'm going to get that correction probably that I'm talking about. If it's bullish, it's still overbought. It's still going up into new high ground, and it's still highly likely to have a downside correction to where we are or significantly lower very quickly. And it's just a correction. Nothing I see causes me to be bearish to any significant extent, price-wise or time-wise. Futures. Of course, the E-mini is the S&P 500, and it's a futures contract. So I show it, and it's overbought for the last 3 days and extremely close to its highs that were made way back in August. So that's resistance on this particular chart. And of course, the October 13th bottom is all over the place in a huge number of symbols, indexes, etc., in a lot of different kinds of markets, and turned everything around on that date. Now, next is bonds. We have support, trend line, bull trend line, bouncing off of yesterday and the low today, and we're up modestly. We have a little bit of a pennant forming, I suppose, and I'm looking for a breakout to the upside, so we're going to start to push up against 129. There's a resistance area all the way up to 135, but closing above 135 is going to be a major bullish long-term breakout, and that's exactly what I expect. It can't happen super fast, so I'm thinking it might be a few weeks or a couple of weeks before that happens. Again, the FOMC meeting in about an hour, 10-year notes, pretty much the same commentary, minor new low yesterday, popping back up today, bullish support line and a bullish trading range support level under the market. I think it's going to head back up again very soon and have that major bullish breakout like the bonds, maybe in the same day. Next chart is crude oil. Here come the energies. Bear trend. We got sell signals on top. Fantastic. That's what the ER signals are built for. Whether they're buy signals like this one on the bottom, green, that is the low day. This is the very beginning high day of the move down, and they clustered. You have 1, 2, that's a high day, 2, and 3, all within about a week and a half. Down it went. All right. So I'm looking for support to be broken, and support is around 64.5. And when that happens, you're probably going to have a very sharp, big break. I wouldn't be surprised to see it drop off to around 50 or the very low 50s pretty quickly. And that is a pretty big break. Next is heating oil. Same kind of comment. Super support level is going to be broken. And that's 2.1352-ish. And when that happens, we're going to see, again, a huge, big break. Probably over a few days. And down quite a bit. I would expect it to be in the ballpark of 1.5. Excuse me. So bearish definitely on energies. We got natural gas, same thing, long-term bear market. We saw a head and shoulder top form. We have a bearish engulfing sell signal on the top day of the head and shoulder formation. You can't get more accurate than the exact day the market turns up or down. All right, so the market has flattened out lately. And if we see new lows on a closing basis, and I mean closing basis when I say new lows, if it makes new lows and then pops back up again above the previous lows, that could be a false downside breakout or what we call a bear trap and cause a little bit of a rally, short covering for a short period of time. It might even be more bullish than that, but it depends upon how it does it. So I'm bearish, looking for new lows. Next chart, gold, silver, and platinum. Gold is holding in a sideways range and has started a bit of a down move. But our last signal was a buy signal at the bottom, of course, and another buy signal. Didn't work very well a couple of days later, but the lowest signal was still at the lowest lows. Support's holding. I wouldn't say particularly well, but it's holding. And we got a little rally today. I need a breakout closing price of 1,992-ish, and especially a little above 2,000 in order to get this bullish ball rolling again. That is a resistance. It stopped the market a couple of times in the last 2 or 3 weeks. And the next time up, I think it'll get through it and just keep on rallying and probably test the highs for the whole trend. Now we've got silver. What an incredible combination of signals. A bull signal on the bottom of the move, March 10th. 2 sell signals at the 2 high days on a double top formation, which started the move down. The minimum downside on this formation, downside objective on this formation, I measured before it happened, and that was at 22.9. It got there only for a day or two, and then a bullish engulfing and started right back up again. I can't tell you how proud I am of these particular signals in the symbol silver. A tongue tie, huh? Next chart is platinum. We got the bottom in platinum, as we did in gold in late February, early March, and silver and platinum. We have a sell signal that didn't work very well in the middle of a little double top, part of a broader double top, where the first time we did catch the top. New lows at the moment, breaking a bull trend line, not particularly convincingly, but oversold. So at the bull trend line or a little bit below, in oversold conditions, it probably will rally a little. I'm going to say up to 998, and it could even get up to, say, 1,040. But I'm expecting it to make new lows soon and continue to trend lower and challenge 913. Next chart, copper. And it's rallying a little bit the last few days after an oversold condition again. As you can imagine, I'm heavily weighted toward RSI. I learned it from Wells Wilder himself, and this is my custom version of RSI. It's been 52 years in this industry, so using RSI for many decades and customizing it to my preferences, I like very much. Also, I love the bullish engulfing or outside trading range day, bearish engulfing candlesticks. So those two features in particular are an integral part of my ER sell signals and buy signals, but there are other details involved for sure. Next, we've got soybeans and grains. Last signal was a buy signal, not at the bottom, unfortunately, but it worked great. And we're an inside day today. Yesterday, it made highest highs and highest closings since the buy signal. I'm looking for higher levels, but we're starting to get very close to overbought, and we're starting to get into some technical resistance. So I feel uncomfortable about going long at these prices, and I would wait to do something one way or the other. I want a signal before I jump. Then I have a defined, pre-decided protective stop in mind, and with the ER signals, that's automated. I know exactly where I stand, how much I'm going to probably lose if I lose, and how much I could make if I do have a profitable trade, which is most of the time. Next, overbought conditions in soybean oil at the moment and a downtrend are going to lead to a high, probably. And we are now at, for the first time for weeks, a resistance level. There's a little bit higher for another resistance level around 58, and we're 56.5. So we possibly would rally a little bit more, but watch very carefully for this soybean oil to turn back down again. Next is soybean meal. Somewhat the opposite lately. We were oversold, we bounced, but not very well, and not even up to resistance. Now we're starting to make a new low close for the trend and almost a new low. So I'm looking for lower lows, and that's what you should be looking for in a bear trend. So I'm looking for a move down to at least 369 and probably lower than that in the next week or two. Next chart is corn. Long-term bear trend line was tested yesterday and the day before. I pointed that out. With a lower close yesterday, that's typical of a reversal after touching a trend line. So today we're about unchanged at the moment, but after a good dip earlier, I'm looking for lower levels. I'm looking for it to come down again to 579-ish and even challenge and make new lows eventually. Next is wheat. Not quite oversold, but very close, and we're bouncing a little. Obviously a bear trend. Looking for lower levels. Don't have a particular downside objective in mind, but I think 570 is an easy target, and that's 60 cents lower, not bad. I also want to point out that we got a sell signal at the top of this market at the beginning of the war. Damn near impossible for other techniques, I have to say, to end up with a signal on the high day after screaming bid limit up on the opening all day long and closing limit up bid for days in a row, or closing limit up days in a row. A whopper of a bull move because of the war, and then we have a sell signal on top. Can't get better than that. Next, Cattle, brand new sell signal today. We had a sell signal a week ago at the top of the rally. Today is a new low since our original sell signal and a quote unquote complimentary, if you like, sell signal again. I like what I see. I'm looking for a test of support, which is down around 163, 164, and probably lower than that, but that's my minimum downside objective in cattle. Again, a second official sell signal today. Next, lean hogs. Overbought, doing pretty much the opposite at the moment of what cattle's doing. So I'm looking for it to stop rallying. It might go up a little bit more. I would claim 93, maybe up to 95, 80, and turn back down again in the next few days. It may not rally quite that high. Since it's overbought, it could turn down any old time, but frequently it's against a traditional technical point like resistance and support and so on, trend lines, gap closures, stuff like that. And there are other tools to use as well. Next, OJ. I don't feel very strongly here about it, but we're close to oversold. The trend is up, probably going to get the resumption of the uptrend soon. Maybe it'll even touch this bull trend line at around 241, but it's going to turn up soon. Next, cocoa had a bad sell signal 2 days ago. Bad cocoa. Had a losing day trade. We're up even more. Thank goodness we're not short, not stubborn, and we follow our rules. That's one thing that neophyte traders don't tend to do very well, is follow the rules. First of all, you got to have pretty good rules. Then you got to learn to have the discipline to follow them. That leads you in the direction of automated trading systems, whether you develop it or not yourself. And that's where I'm at. The ER signals, 100% automated. We had a bad trade, bad signal. So what? You got them once in a while. Don't lose a lot of money. Next, cotton, big sideways trading range, major boring since last October, November, several months. So I'm waiting for a bullish or bearish breakout. Looks likely to be bearish because the overall long-term trend is down. Next, sugar the sweet. Bull trend has had a correction, probably going to, after being oversold a few days ago, rally into new high ground. And we're back to the E-mini. Be careful, people. We might have some bearish comments or no significantly more bullish than expected comments on the Fed's part in about 45 minutes. Pay attention. Have a great day. Talk to you tomorrow.